Hi, this is Ron Rowland from Money Markets TV. Over the past few months, I've told you about dozens of exchange-traded funds that I believe could help you make money in 2012. But just as important as buying investments that rise in value is avoiding investments that decline. So today I want to talk to you about an ETF category you should stay away from this year. That's Japan. You may argue that the country's stock markets look oversold, but I don't think it's hit bottom yet. And I have 6 reasons why. First, the yen is extremely strong. That's bad news because it makes Japan's exports more expensive than those of its competitors. And exports are a huge part of Japan's economy. The Bank of Japan intervened a number of times last year to try to devalue the yen, but each time the impact of its actions has lasted for only a few days. The second reason to avoid Japan is the crisis in Europe. Most analysts now expect that the economic slowdown in the Eurozone will be severe and prolonged. And a huge chunk of Japanese exports go to Europe. If Europeans have no money to spend, their demand for imports is going to plummet. Another bad sign for Japan is the emergence of hungry competitors such as Taiwan, South Korea, Brazil, India, and of course China. These countries can all do the same thing that helped Japan achieve economic success: beat the developed countries in cheap, efficient manufacturing. And in some cases, they can do it better. A nation like Brazil has even more advantages over Japan, like better access to natural resources and geographical proximity to key markets. Japan's population is also one of the oldest on the planet, and a relatively small number of young adults has a very low birth rate. The resulting imbalance is making it harder and harder for Japanese industry to keep growing. Older workers hang on to their jobs for dear life while younger people have no way to gain skills. Japan's aging population is a major cause of another problem facing the country: massive government debt. It's expected to surpass 1 quadrillion yen this year, due largely to heavy spending on health care and pensions. To stay afloat, Japan will almost certainly need to raise taxes on both individuals and businesses. And higher taxes won't make it any easier to create economic growth. The final reason to avoid Japan in 2012 is political instability. Japan has had 6 different prime ministers since 2006, and the current occupant, Yoshihiko Noda, is already under fire after only 3 months. But changing leadership is just a symptom of the real problem: Japan's voters and their unrealistic expectations. Japanese stocks may experience some short-term rallies this year, but I think the best opportunities will be elsewhere. A number of ETFs have heavy exposure to Japan, including offerings from Wisdom Tree, iShares, and Spider. If any of these are in your portfolio, I suggest you look for a chance to get out as soon as possible. Now, there is an ETF that's designed to go up as Japanese stocks fall. ProShares Ultra Short MSCI Japan is a 2 times leveraged inverse fund. However, EWV is strictly for short-term trading. I don't recommend it as a long-term investment. In the coming weeks, I'll examine some more ideas on what to do with the money that you aren't investing in Japan. For Money Markets TV, I'm Ron Rowland. Thanks for watching.